Hi everyone, I wanted to walk you through this simplified pro forma that you can use for your assignment this week. Pro formas are really complex, but they're an important starting point for entrepreneurs to be able to understand the numbers behind their business. It typically takes weeks to do a pro forma, but because we don't have that kind of time, I'm going to narrow this down and simplify the process a little bit for you so you can get a feel for it. Let's start with the first number here, which is paid in capital. So in this space here, you would put in whatever money you think you would have for your initial investment. Make sense? Okay, so the second item you would put what interest rate you think you might earn on cash balances. So if the going interest rate is around 3%, you would stick that in. If you think the next line would be tax rate for taxable income. So the average now is about 30%, so that's what number you would use. The important thing to remember here is anything that's in this bold blue, you can change. Everything that's black, like down here at the total product activity, sales activity, those are all calculated fields. So now that we have this part here with the basic setup, I want to walk you through some of the other assumptions and how they drive the other spreadsheets. In a typical pro forma, this would be a month rather than a year. So instead of having year 1, year 2, and year 3, you would have month 1, month 2, month 3, all the way out to month 36. So you would do a 3-year pro forma. Here on your product sales activity, I've listed product 1, product 2, product 3. I've listed service. You may or may not have services or products, or you might have both as is here. I would encourage you to change that as it reflects to your specific business and update these product lines if it does align with your business. So this is sales revenue assumptions, and we start with the sales activity. So we're going to put over here on this side the actual number of products we think that will sell in the first year. That would be in the first 12 months. So product 1, I put in 1,500 units, product 2, 2,500 units, product 3, 1,000 units for product 3, and I put in some numbers for services. So it calculates for us the total product sales activity. And then the next section, we're looking at revenue. So I said my first product would be 50 bucks, the second one will be 35, and these are actually the sales costs and sales revenue numbers, and the third product would be 25. So when I put these numbers in here, it calculates the sales volume. So 50 times 1,500 gives me $75,000 in sales volume. So you see how that works. So whatever you change here, you need to also change down here. So this gives us a good picture of here are the number of units I think I'm going to sell, and here's what I'm going to charge, and here's how much money I think I'm going to make off of those. And then the next section is, we'll start with cost of goods. So again, you see the product and the service items again. And now I've built in the average cost, not the revenue. So if product 1 costs me $22 to make, and I'm going to say, let's say sell 1,500 of them, then it's going to have a product cost of $33,000. Make sense? So you do that for each of your product or service lines. And then you come in and put your operational expenses. So what do you think you'll spend in rent for a year? For this one particularly, I said $500 a month for rent times 12. If you were to do this in a more complex manner, as you would set up your business, you would break these out by months, and you would actually have monthly costs here. And it's important to think about that, because in some businesses there's quite a bit of seasonality. So in some months you may make money, some months you may lose money, and it's good to be able to see that, particularly if you're looking for investment or you're looking for lending to support your business operation. The summary that we're doing here for the year is probably not going to be sufficient for most investors that want to see a more detailed approach. So I've broken down our operational expenses, put a bunch of marketing expenses, and you may or may not have these. You may have other expenses here, operational expenses that you think might need to change. I put in things like a marketing assistant, a customer service rep, owner salary. All of those numbers can change. Okay, and then I made the assumption that we needed to buy 2 pieces of equipment, and those were $5,000 each. And then there is a straight line depreciation method, which is basically you split this cost over 3 years. So in this case, it would be $33.33 that we would depreciate on a $10,000 investment. So the next sheet is cash uses and sources. So if you look at this, this is really a cash flow statement. So this doesn't have any blue numbers, and that's because it's all calculated from your assumptions. So if you make changes to your business model here, it will flow through to cash uses and sources, to income statement, and to the balance sheet. That's what we talk about in the book and the assignments as an integrated financial forecast. So in these cases, you make your assumptions here, and you should be able to dissect this, add to this, detract from the, or subtract from this things that you don't need. And you have to make sure that if you make changes, that you also make those other changes here and bring your formulas over so that everything adds up. Otherwise, you can get things out of whack really quickly. So in this, with these sets of assumptions, with a $75,000 investment, I can go to cash uses and sources, and I can see my $75,000 investment. I can see a summary of my sales here in the first year, what it's going to cost me to manufacture, what my overall costs are going to be, and then it tells me, even after I buy the equipment, the $10,000 in equipment at the end of the year, I should have, if all goes the way it's supposed to, and I will tell you that it will not go this way, it will not go the way you expect it to, but if it does, you should have an ending cash balance of $2,600. So that is what you will have in cash with your $75,000 investment, and assuming everything goes as you have planned here and in line with your assumptions. So year two, what you do is you carry this cash from year one up to the top where it says prior month's cash balance, and then any interest on cash that you might have, and then you go through all of your other expenses, and then you end up at this, in this scenario, $48,000, and then we come back up to year three and we bring that $48,530 and we go through all of our expenses again. Now you'll notice it doesn't show any profit and loss, and the cash uses and sources isn't supposed to do that. This is all about helping you identify your cash flow. This is why when you do this for your own business, you should do this monthly, because cash flow on a monthly basis is incredibly important to keep track of. Now we take a look at our income statement. So our income statement brings many of the same numbers in, but it looks at them a little differently. We're not concerned here with the cash, but we're concerned here with revenue and expenses and what our profitability is. So in the year one, we see that we're going to bring in $200,000 in sales, $227,250 in sales. We're going to have $94,000 in cost of goods, and we'll have a gross margin of $133,200. We have $145,000 in expenses, which says we're going to lose $12,449, and we don't have any tax or interest on that, and our net taxable income after depreciation will be $15,000. So the next year we go through the same scenario, and you see that we have a provision for taxes. So the provision for taxes says we've got to pay taxes at the end of the year. So it's this number, our net taxable income, times the tax rate for net taxable income over here, which gives us this number, which we subtract. So our net income in the second year will be $121,297. And we do the same for the third year. So the balance sheet is the profit and loss or income statement is concerned with the expenses versus the income, and the balance sheet is concerned with the assets and the liabilities as it explains in the book. So in this case, we're talking about cash as an asset, receivables, inventory, fixed assets, less accumulated depreciation, which is the 1330 or the 3033. 3 that we noted earlier. So we have total assets here, and then we have our paid-in capital and our retained earnings, which would be our losses, and for this year, so that we have a total equity of $9,000. So you can see how these numbers change year to year based on what the income, the cash, or receivables, or inventory, or other things, the payables that would affect the business, would show up here. For this particular balance sheet, they're making some assumptions, and that is you won't owe anybody money at the end of the year, and no one will owe you money, and it also assumes you're not carrying any inventory. If those things change, then new numbers have to be put in here. Okay? I hope that all makes sense to you. The important thing to remember is that you start here. Now I want to show you one last thing. I want to show you how this works. So let's say this is our cash flow statement, right? And this is still based on $75,000 in income. You can see, or initial investment. So you can see with $75,000 in initial investment, we're going to lose $15,000 the first year. But that's probably okay. I mean, it's not ideal, but it's okay because we have the cash, right? So we're going to have an ending cash balance of a couple $1,000, and we'll be able to make this work. We might be able to cut back on some of our expenses here to manage cash a little bit better, and that's something that we'll talk some more about as we move through our course. So what happens if our initial cash investment was, say, $25,000? We change that number here, and we go back and look at cash uses and sources, and we see $25,000 here, and we have too many expenses versus our revenue. So what do we have to do? You know, look at this bottom line. Now we're down $47,000 instead of $15,000. So now we've burned through a lot of our cash. So one of the things that we have to think about is, where do we make changes? Do we need this much in terms of payroll? Do we need this much expenditure here? The only thing you can do if you only have a fixed amount of cash is to either reduce your expenses or increase your revenue, and you would make those changes back on this side of the sheet. Okay, you can increase the price, you can increase the number of products sold, but you should choose realistic numbers here. Or you can come down here and figure out how to best reduce the cost of the production or reduce your operational expenses to be able to come in line. You see, your income statement doesn't really change all that much, but your balance sheet changes significantly when we make that change. So your income statement says you still lost $15,000. The balance sheet says you know your liabilities and equity are kind of way over what they need to be. So you want to come back, and just for the purposes of this exercise, let's put that $75,000 back in there so that you have something to start with, so that you can see what a more positive approach would be for your business. So I hope this is helpful to you. I'm going to make this template available, and you can use this and make changes to this as you would want to. If you have any questions on it, please let me know. I'm also going to include links to a more complex monthly type of pro forma that is put together by SCORE and the Small Business Administration that might be beneficial to you as you plan out your longer term plans. But for this exercise, make the changes that you need to make here and flesh it out based on this kind of summary approach, so that we can incorporate this information into your video pitch. That's all for this time. Thanks.